Hello again, everybody. Hugh Johnson here, and trying to get you up to date, bring you up to date on some of our thinking in this extremely tumultuous period, both for the financial markets as well as, to a lesser extent, the U.S. economy, but certainly political conditions in the U.S. We're starting now, right after health care reform had been turned down by the U.S. House of Representatives. They decided not to go ahead. And they decided to refocus or focus right now on tax cuts and spending increases, or so we call it the Trump plan, the Trump economic plan. I think what we learned, one important lesson is that, look, we've got the Trump plan. We've been looking at the Trump plan for some time, but we've learned that it's not going to be clear sailing through the House of Representatives, and certainly not the Senate, but most importantly, the House of Representatives. It's clear that there's some, we'll call them deficit hawks, the Freedom Caucus, even Speaker Ryan, who insists that if we're going to do anything in the form of tax cuts or spending increases, we're going to do it in a way that they're offsets, they're revenue offsets, so that we won't increase the federal budget deficit and the size of U.S. federal debt. That's going to be very important, which means it's going to be very difficult to negotiate or to get through the tax cuts, which the stock market, since the election day, has been effectively reflecting, discounting, or putting in place. In other words, investors have collectively decided that we are going to get significant tax cuts. We are going to get significant increases in spending. It will be stimulatory to the economy. It will help corporate profits. It will help S&P 500 earnings, and it will help, therefore, stock prices. And the market has been discounting that, but I think getting well ahead of itself, because that's really not consistent with political reality. And if we learned anything from the health care problems that face the House of Representatives, the debate is we learned that that isn't going to be clear sailing, that we cannot expect all that we had been previously hoping for. Okay, where are we? Where we are right now is the stock market's in the process of declining or having a slight modest correction, a correction in response to what we'll call political reality. That's very good news, because it had reached a level which, in our judgment, had become ahead of itself. You know, we're up 9.5% since the election. It's about a 30 to 40% average annual rate. You know, common sense alone says that's a little bit too far, too fast. And it was too far, too fast. And again, discounting a lot of political things that were going to happen but are simply not in the cards. So the market was overvalued, and now we're declining back towards levels that make more sense, or hopefully we'll get to a level that's undervalued and we can become a little bit more optimistic about prospects for stocks. The point being is valuation has been a problem. It's not that, even though this has been a very long stock market cycle, a very long economic recovery, a very long or very brief right now interest rate cycle, but could be significantly longer. Even though that's been the case, we still don't have all of those conditions that seem to fall in place when we're at the peak or that we're at the end of the cycle. So the cycle continues. The problem is primarily valuation. And we right now are sort of holding our ground right now, watching the markets and seeing what lies ahead. You know, it may be the case that if the market declines, we start to get some negative signals from the sector performance, capitalization performance, style performance, spreads that exist in the interest rates, a lot of technical things that go on in the financial markets and tell us whether we're in for something that's a more significant decline or something that we'll call a correction. Right now, what I'm seeing, or what we're seeing, says to me that yes, the bull market, the economic recovery is still alive and well, and that what we're going through is an economic, simply a stock market correction in the context of an ongoing bull market, a correction that hopefully will take us to a level that makes much more sense. But we'll watch it very carefully to see if there's signals that are stronger than that say that we're at the end of the cycle. Right now, we don't see those things that signal we are at the end of the cycle. So what should lie ahead? There'll be a very heated debate on what we're going to get in the form of tax cuts. There are going to have to be some revenue offsets. You're going to hear the word border adjustment. We know all a lot about border adjustment. Quite frankly, I think it's going to be difficult to get border adjustment through because there's so many companies, U.S. companies, that will be helped and so many companies that will be hurt, significantly hurt by any border adjustment tax. So using a border adjustment tax, if you may, to try to find those revenues to offset the lost revenues from tax cuts is going to be extremely difficult. We're probably going to have to find it elsewhere. There are a couple things you're going to see. You're going to see a decline in corporate tax rates. You're going to see a repatriation of the cash that's in the coffers of U.S. companies on their earnings in other parts of the world, which haven't been returned to the U.S. because tax rates are so high. You're going to see a repatriation because there'll be a, let's call it a tax holiday for those companies. There'll be other things that'll be in the form of tax cuts. We'll see some spending increases, defense, some infrastructure. There'll be some stimulus, but we'll see a very heated debate over the revenue offsets so that we can keep the deficits down, keep the debt down. So we're in for a very difficult period, a period of volatility, but hopefully during this period we get to a level that makes a lot more sense. Again, don't see the end of the cycle right now. That's the good news. The bad news, a little bit of a valuation problem. The very good news is I think we're in the process of correcting out that valuation problem, getting to levels that make more sense. We really appreciate the confidence you continue to show in us, and we're working really hard on refining our whole approach to the financial markets, refining and improving, doing these things and doing them well on your behalf. Over the long period, we're very optimistic that we'll be able to be doing very well and everybody will reach their investment goals. So thanks for your confidence, and I look forward to speaking to you again soon as we work our way through this intensely difficult and very volatile and interesting political period. Thanks very much, and look forward to seeing you next time.